Yeah, just help us
Morning, how are
understand
you?
the thinking there. You guys went neutral.
Yeah, so I mean, obviously we went overweight in March on very cheap valuations, and the idea that the authorities would increase the stimulus and support the economy, and obviously try and help address some of the property market concerns. And actually, most of that has come true in terms of we have seen additional stimulus. We've seen the authorities take those measures on the property sector, but obviously the zero COVID stance needs this to be, to some degree, pushing on a string when it comes to policy stimulus, because obviously if you're locking down the economy, and then it does make it harder to achieve the growth targets the authorities have set out, and give people confidence that in the increased certainty of that outlook as well, which is obviously important when it comes to investment. So it's been a challenging environment. We still think that the market obviously still is very cheap. You've seen the declines in prices, but we're seeing downward earnings revisions coming through. So we're probably looking now for those zero COVID stance to be eased, maybe sort of Q2 next year. That's a bit further out than we were initially anticipating. So hence a little bit more cautious on the market, not bearish at this stage, of course. We have seen a lot of weakness already, but probably maybe delaying that recovery that we were expecting, or that outperformance we were expecting.
Broadly speaking, if you take a look at just the week that we have across assets and just the damage that we've seen, Steve, is there a case to be made to be buying on this weakness now?
I think there's always the case. I mean, obviously, if you're sitting on excessive cash holdings, then this is a great time to be adding to assets just generally, as you alluded to. Bonds have sold off significantly. Equities have also sold off. But we're still in a highly uncertain environment. So we wouldn't say if you've got $100 to invest $100 today. We'd probably be going in, $30 or $40, something like that, because we still think there could be further downside for asset classes. So we still see that bond yields could go a little bit higher from here, as well as equity markets look at particularly vulnerable. I mean, if you look at the Fed conversation that was, or the forecasts that were coming out earlier in the week, obviously they're saying higher inflation, higher interest rates, very, very slow growth, and higher unemployment. That does show that the risks of a recession are rising. Has it been priced to some degree? Yes. But has it been priced to the totality? We're less sure of that.
Yeah, Steve, some of our guests this week would at least took the opposite view with the yields on the table right now. You could construct a portfolio almost risk-free 5% if you're a long-term investor. Could you just argue the other side of that a little bit further for us, please? Because I think that's not a lot of people talk about what the Fed is really telling us still.
Yeah, no, I mean, at some point, obviously, we do think that the Fed will have to pivot, in terms of moving away from this, because at the end of the day, if growth slows as projected by the Fed itself, then inflation expectations and inflation should come significantly lower, and that will allow them to reverse course. So absolutely, the spike in yield looks very enticing to many investors, and that makes sense if you're looking at even double Bs in the high yield space at 7% yield. You can make a very good case saying, look, we haven't seen these for a very long time as we're heading into recession. Maybe they do look attractive. The way we look to play that is actually through a sort of a diversified multi-asset income portfolio. So we've sort of targeted historically 4 to 5%. 2 years ago, it's very difficult to get even 4%. I think the yield we had was around 3.9 on our income allocation. Now, obviously, we're above 6%, and that has some growth assets in there as well to protect and support total returns. So that's the way we prefer to be playing it. So we're overweight in income allocation over a sort of more risk-based balanced portfolio at this stage, because those yields have been going across different asset classes.
Yeah, so yields, income strategies, barbell it, diversify. Steve, I saw in your notes, though, something that really kind of struck me, that you're liking UK stocks. Quite contrarian. Tell us why.
Yeah, it peaks interest, right? Especially when you've got the Bank of England hiking rates by 50 basis points rather than the 75 basis points people are expecting, probably because of growth concerns. And we look, if you look at the US, Europe, and the UK. The UK looks most nailed on for a recession. But we look at it as saying, okay, fine, yes, the news is very bad. Inflation is extremely high. Growth is going to be very weak. Fiscal policy is very supportive. That's hurting sterling. But if you look at, just step back from that, you say, okay, but if you look at the price earnings ratio, we're at 30-year lows here. So from that perspective, the market has discounted a huge amount of bad news already. And that sterling weakness is very positive for the FTSE 100, which still generates the vast majority of its earnings from overseas. So yes, it looks a pretty bleak environment in the UK. But if you're looking at the, what's price and dividend yields, obviously very attractive. Also biased towards the sectors that we generally prefer, whether it's energy or financials.
Right.
So actually, you can make a compelling case for UK equities here.
Steve, the other side to that is if you're a dollar investor, how do you hedge that currency exposure? Our colleague Brice pointing out the cable is at levels last seen during Phil Collins' time in the early 80s. How should I be looking at currency exposure at this point for dollar investors?
Yeah, so I mean, obviously you can take it either way, right? You can say the vast majority of the sterling weakness is probably done, but certainly the short-term outlook is for sterling to continue to weaken from here. So, we'd probably in the short term at least take that overweight to UK equities on a currency hedge basis, looking to unwind that currency hedge as sterling bottoms later in the year or maybe in the beginning of next year.